Hey, folks, my guest today is Oleg Mukanov. He's the co-founder and COO/CFO at SteadyPay, an award-winning London fintech focused on providing income stability solutions for the gig economy. Also an angel investor and advisor to early-stage startups. He was previously a partner and COO at a London and New York-based venture capital fund called Enso Ventures, as well as executive director of some of their portfolio companies. Oleg, you ready to take us to the top?
Yeah.
All right,
Thank you for
so
having me, Nathan.
this is sort of like buy now, pay later, but for personal paychecks, huh?
Well, yes and no. So what we're effectively doing is new type of SaaS. We like to call it salary as a service, right? A new use for the same abbreviation. So effectively, what's tackling is that about 50% of workforce globally do not have fixed paycheck, meaning that some months, weeks, or fortnights they earn above average. Sometimes they earn below average, and whatever they earn below average, there is not much they can do because they're usually priced out of the traditional market, can access traditional products. So what we do, we automatically provide them the shortfall if they earn below average, and they repay us when they earn above average. So effectively, we convert irregular pay to a fixed salary, and we do not charge interest. We just charge a membership fee. Think about us as Netflix for credit.
And this makes a lot of sense. But I guess my question is, how does someone establish to you? What data do they have to give you so you can establish what the average is?
That's actually the cool trick which we're doing, and that's why we could grow so quickly. We connect directly to their bank accounts, and we use technology to actually get all the data. So everything from ID check, KYC, IML, establishing their credit risk, as well their average, and tracking it in real time is done by tech directly to the through the banking connection. So in the UK, we use something called open banking. In other countries, we might use API connections, screen scraping, and whatnot. That's why effectively customers can onboard in 2 or 3 minutes, and the rest is done automatically.
So when you look at your entire user base using you right now, what is for the average paycheck per month, would you say?
Yeah, so we're talking at pretty close to the average income in the UK. So we're talking about £2,000, call it $2,500 net into your bank account after taxes. So that's
Per
kind of
month.
low mid to mid level of income. So basically the backbone of UK economy.
That's per month, right?
Correct, correct.
Okay. So now let's say I'm a user, just so my audience can really understand this. Let's say April's been a bad month for me. You see via my open banking API connection that I've only collected net after taxes about $1,500. You'll give me an extra $1,000.
Correct. So no questions asked, as long as you're within the risk parameters. Yeah, you just get automatically another 1K into your bank account to make up for it.
And
Because
how long do I have to pay that back?
oh, it depends on how much you earn next month. So for instance, next month you can earn another $200 below your average, will give you some more money to make up for it. Obviously, there is a limit depending on the customer. So we're aiming for about £1,000 per customer limit. But effectively, you pay us back only when you earn at or above average.
hmm So the obvious question is, what if my business is declining and I never have a month again where I go above average? How do you ever get your money back?
That's a really good question. There are two things to keep in mind. Number one is we do not charge interest, but we do charge membership. So as long as you pay a membership fee, we still make certain amount of economics from our customers. And number two, it's underwriting. At the end of the day, we provide a credit to our customers, and there is no escape from the fact that some of the customers might not pay us back. Some customers will default. And that's where the whole magic of using open banking and machine learning to actually identify good customers comes in play.
Oh, what's going on there, YouTube? Good to see you guys. Now imagine this. You love watching these interviews with SaaS founders, but imagine if we took all of the valuation data out from over 2,807 interviews I've done manually. Saves you a lot of time. Well, we've done this. We've built it into the beautiful interface inside of FounderPath. Check this out. I'll show you how you can access this in a second, but you log in, you connect your Stripe account, you see your valuation real time. You can see what it changed over the past 88 days and even set goals for valuation this year. Now, the secret to valuation is there's many different ways to value a SaaS business. So the reason you're going to see 3 or 4 different valuations inside of your FounderPath dashboard, this is all free by the way, is because depending on who's doing the buying of your SaaS company, you're going to get a different valuation. A VC is going to pay a different valuation. Private equity firm is different. If you're going to do a minority sale, that's different. And if you sell the whole business, that's a different valuation. You can see all those when I hover over here. Right. So the teal is what a VC would pay. Yellow is what private equity, and red is if you sold the whole thing outright. Now, what's cool about this is not built off random data. Again, you guys hear these interviews on YouTube. All these data are built from real-time valuation data points founders share with us on the show. So traction, 1.2 million, seed round, 3.7 raise. They sold 22% of their business. Go in here and filter by the event. Maybe you only want to see companies that have sold the whole business. Well, here are a bunch that have been acquired, the valuation and the multiple. Maybe you're going out right now and you're raising your seed round. Well, go in here and look at all this recent seed deals that went down, what they raised, what valuation they raised at, and what percent that they sold. There's never been a larger data set of SaaS valuations than what you can get now inside of FounderPath, and we're thrilled to bring it to you. All right, we're going to go back to the YouTube video here in a second, but if you want to check this tool out, if you want to jump in and sign up, you can check it out for free to get your valuation at this link, founderpath.com/products/valuations. Or if you go to founderpath.com and hover over products, click on get your valuation here and go ahead and sign up to give it a whirl. Again, all that valuation data live right inside the platform. I hope to see you there. All right, let's jump back into the interview. I see. Okay, what's the membership fee per month?
So membership fee depends on the tier of the product, but for our flagship product, it's £4 per week or £16 per month, give or take.
Okay, so about $20 on average per month,
Correct.
something like that.
Yeah.
Okay, interesting. So $20 per month. And then I guess now that we sort of understand pricing, what the product is, put this all on a timeline for me. When did you write the first line of code for the platform?
So we started in 2018 and we started two workflows in parallel. One is writing our MVP, but at the same time getting approval with our regulator in the UK, FCA, because it's such a new product and nobody has done it before. We actually went through the sandbox program. So we were working directly with the regulator to figure out what would be the right regulatory framework for us. Then we launched a closed beta for our product in beginning of 2019. So we had 100 people to test whether it works or not. Then closed our first institutional round in the end of 2019 and started scaling up in the beginning of 2020.
And so how much did you raise in 2019?
So in 2019, we raised less than $1 million in total between family and friends and bootstrapping between the founders. Then at the end of 19, we raised just over £1 million of equity and 1.5 million of debt to actually provide lending to our customers. And then we just closed a couple months ago our Series A with another 5 million.
Okay, so just because in 2020, 1.5 million equity and 1.5 million debt.
So at the end of 2019, beginning of 2020, 1 million of equity, 1.5 million of debt. Before that, call it $500,000 of equity, and now another 5 million of equity.
Got it. So you just this year raised another 5 million of equity. Any
Correct.
more debt, or you're still using that $1 million facility?
We're in the process of actually refinancing it as we speak as a next step.
Very cool. Okay, cool. Got it. So I guess the right question is, so today, how many customers are you serving?
Yeah. So currently, as of today, we have 10,000 customers on our platform.
Oh, well, that's a big milestone. Congratulations.
Yeah. Thank you.
Can I take 10,000 times $20 a month? You're doing about $200,000 a month in revenue from fees.
Yes and no, because customers are on a different tier of the offering, because that's the revenue for the top tier. And the lowest tier is $5 per month, which is credit building only. So effectively, if you take the average, you're getting just over 1 million annual recurring revenue right now.
Okay, got it. So you're at about $83,000 a month in revenue across 10,000 customers.
Correct.
Okay, got it. Yeah, so that's about more like an average of $8 per customer per month,
Correct.
Something like that. Yeah.
Because there is a different rate of tiers on the customers. Congrats on breaking the
$1 million mark. That's obviously a big milestone. Where were you exactly a year ago? Do you remember?
Exactly a year ago, we were at about what was it? About 4,000 customers. So we increased our customer base by 2.5 times.
Yeah, so you grew from like $32,000 a month to $83,000 a month, right?
Yeah, and managed to do it actually in a cost-efficient manner. So not only we grew to 1 million annual recurring revenue, we actually broke even at that stage, which is quite exciting.
Broke even last year?
Yeah.
Very cool. Obviously, you raised more today, so you're maybe burning. Now, when you raise that 5 million seed, most of the metrics I'm seeing say when folks are raising their seed, you're selling, between 10 and 20% of the business. Were you in that same range?
Yeah.
Okay, so you're about a 40 million valuation, something like that, 30, 40 million?
Well, not gonna give you exact number, but it's getting close to that, yes.
Okay. Okay, got it. So less than 30 million valuation, but still healthy. Talk to me a little bit more about the warehouse facility. I mean, I'm very familiar with sort of bankruptcy remote SPVs, these fintech folks raising balance sheet capital. You're usually raising a warehouse facility and you got to pay an interest rate on that $1 million you raised, right? So,
Yeah.
I mean, is that how yours works?
Well, it's more like an RCF, or you can call it accordion facility. So you pre-agree limits and then you do monthly drawdowns and you pay interest on the drawn down portion. So original facility actually is quite healthy from the interest perspective, but does carry some warrants, as you can expect in the early stage facility. But no commitment fee or anything, which is quite exciting. I think the next facility which we're raising right now will be with no equity element, but we'll probably have to pay some commitment fees, moving more into the kind of institutional style facility.
Yeah, commitment or unused fees, right? So if it's a $10 million facility, you only use 2 million, you have to pay fees on the 8 million you haven't deployed yet.
That's right.
Which brings up a big question for you, right? So like your ability to recycle capital quickly, especially over a year, is ultimately what could generate an interesting return for you. You don't have to call it an interest rate, but just to be clear, you're like, let's say that example earlier, right? I'm only make 1,500 this month. You give me another 1,000. Let's say the next month I make 3,500. Do I pay you back that full 1,000 that next month? Exactly 1,000?
You don't. So actually, when you get a top up, you've got indicative repayment schedule, and it depends on your payment cycle. So if you'd say on a monthly payment cycle, usually repay it within 3 months. If you have a big balance, if you have average balance, 2 months. If you have a smallish balance, it's 1 month. Because we've done a lot of modeling and analysis of the cash flows of our customers to figure out what actually healthy for them, not only from a top-up perspective, but also from the repayment perspective.
Well, if you force me to take 3 months to repay it, though, and I'm paying a $20 a month fee, that's a $60 fee against a $1,000 loan, which is effectively 6% over 3 months, correct?
Yeah, so our annual interest is at 20.8%.
Yeah. So you can you've structured this in a way where it's not actually sort of an interest rate because you have a fixed fee model, but because of how you structure the timing, you can really back into an interest rate of about 20% on your facility.
Correct.
Yeah.
And the way we wanted to structure it, on one hand, to make it reasonably priced, but on the other hand, to actually make it simple for the customers. Because if you look at the majority of customers in this income bracket, the level of financial sophistication is not that great. And people genuinely either do not understand interest or intentionally do not want to understand how it works.
Yeah, I would completely agree with that. So as of today, like right now, how much total capital do you have deployed out of your facility?
Oh, that's really good. That's a really good question. It's safe to say that over the last 2.5 years, we recycled facility more than twice already.
Okay, so you've deployed more than $2 million in total sort of loans done effectively.
So actually, if I convert into dollars, we're talking closer to $3 million of loans advanced over that period of time.
I see. And so how do you determine what size of your next warehouse facility should be? It's tricky math to do because you're constantly having to recycle. So you have to project and forecast demand.
Yeah, correct. So good old financial modeling and forecasting, you basically back calculate how many customers you will get, then you split them between different subscription tiers. You take the average balance per customer at any point in time, and that's how you get to your target facility size. So,
okay. But if you look at your utilization on your current $1 million facility, I mean, is it fair to say you probably have like 800, 900,000 of it out right now? It's basically fully deployed.
Yeah. Sounds about right.
Yeah, interesting. And if you needed to do more top-ups, but you've already used your whole warehouse facility, you could dip into your equity if you wanted until you raise the next warehouse facility, right?
Correct.
Yeah. And have you generated capital stack here, or is all your capital just coming from this one provider, the $1 million warehouse?
No, actually, depending on the business lines, because we're doing pilots of another business line where we have another finance provider. So we have 2 groups of finance providers at the moment.
Okay, okay. And most of these initial warehouse facilities into fintech companies like yours, you're typically have 1 to 2% warrants, which you've already addressed. There's also usually an interest rate of something between like 10 and 13%. Were you guys in that range?
Well, a bit higher, but yes.
Okay, so call it north of 13%. So if you're making 20% minus 13%, you have a spread of about 6% on a million lent out. So that's additional revenue for you on top of the $1 million SaaS run rate, right?
Yeah, but if you actually look at it, that's the most expensive pricing you will ever pay, and you pay just to do the proof of concept. Because if you actually look at the warehouse facility at the good size, call it 5 million plus, you're probably looking at high single digits, low double digits without equity, meaning that you're not going to make much of the economics in early stages when you're proving the concept. It's only when you start scaling up and refinance that's where the majority of economics will start trickling in.
Yeah, well, that used to be true, but with the current interest rate environment, it's becoming harder and harder to figure out for fintech companies what yields and spreads might look like 4 or 5 years from now, even 1 year from now. So, I mean, I know a lot of people that raised a warehouse facility at 14%, then they got it down to 8%, but it's floating against SOFR, right? And
Yeah,
so if it's floating, you have no idea what you're not in control of
yeah.
your yield moving forward. So like it's very interesting to me. You're going through this right now. I mean, how are you thinking about locking down that warehouse facility? Would you prefer a fixed rate that's higher or one that's variable but lower to start with?
I would say a couple of things to keep in mind. One is I prefer fixed. Again, it's a little bit easy because we pay fixed subscription to all customers and we pay fixed interest. So it's actually quite good natural hedge in a way because we do not have any floating rates. But second one, we can always play around with the compensation of our portfolio because we have a range of products depending on the limit and depending on the services. And one thing we have a control on in case, let's say, certain levels of lending becoming quite expensive, we can always rebalance our portfolio. Potentially, it means we will leave some of the customers on the table, but at the same time, we have pretty good flexibility when managing our capital structure.
Yep. How much capital have you lent out that is now defaulted? You're not going to get it back.
Below 10%.
Okay, so below 100,000 of the million.
Yeah.
That's pretty high, though. You want to be under 3% vintage default rate in these kind of businesses.
Well, there is a difference between default rate and total loss rate in our case, right? Because people might have defaulted on repayment, but they still pay subscriptions and they still legally owe us, meaning that we actually have a good percentage of customers who go into default and then go back into good customers. So technically they could be in default and it's down to us actually to enforce them or not. And given that it's a gig economy workers with volatile income, there is very little benefit in enforcing it. So we're actually taking an approach more of being friendly, nurturing, and getting customers back on track. In terms of total loss, actually, it's getting close to like 3%, which you're talking about.
I see. How do you make sure there's a lot of services like you? How do you make sure that the same gig economy worker doesn't apply for you guys and seven others at the same time? And all of you guys have now given them way too much debt.
We see their bank account. So we see
But the people have multiple bank accounts.
Okay, that's a really good question. So we require quite a lot of things on the back end, but the most important one, we need to be connected to the account where they're getting their main income. And across this account or several accounts, because we have functionality to connect across, reconcile several accounts, there should be certain expenditure visibility, meaning that above 70% of all the income they're getting, we need to see where it's spent on. Meaning if they have one bank account and then they get income there and then transfer all the income to another bank account, they're not going to qualify. Because although we see the income, we do not see enough of the visibility on the outgoings.
I see. That makes sense to me. And I guess the last question here before we wrap up, what kills businesses like the one you're building is two things. One, yield compression, right? If a lot of money comes in and people lower their rates and there's no yield left for you to make. The second is CAC arbitrage. Can you keep getting customers cheaply so you can keep recycling really fast on larger and larger warehouse facilities? So how are you getting customers today? What is your CAC arbitrage today?
So we started with direct marketing because we're up only. So there is no point in trying even before we do that other channels. So we've done Facebook, Google worked really well. And we are starting to push more and more into B2B partnerships because if you think about it, it's a push-pull strategy. Let's say if we have enough ride-hailing customers on our platform, then it becomes quite an obvious thing to do is go to this ride-hailing company and effectively offer that as employee benefit, and we're getting more and more inquiries and pushes in these regards. So if you think about it, we use direct marketing to generate the critical mass enough to be noticeable and have those specific groups clustered around specific employers, and then go directly to employers to capture the residual employment base through the partnership angle.
So these massive marketplaces are good targets for you, like Fiverr, TopTal, also the ride, the Ubers where there's thousands or hundreds of thousands of contractors is great for you too. The problem that you're seeing here though is if you partner with Uber and do this for Uber employees, right, to stream out the drivers' revenue, the income streams, and Uber will realize how big of a business this is. This is why embedded finance is taking off. So how do you compete against that over the long term? Wouldn't people just build you internally themselves?
That's actually a really good question. At the end of the day, it's still quite heavily regulated consumer credit business, meaning the barriers for entry are quite high, and you do carry underwriting and default risk, meaning that you need to have a proper treasury collection and credit risk function. So if you throw a lot of money in it, throw a lot of people, you can build it. But actually what we've been noticing is that the businesses just prefer to outsource this function to someone else. And also from the reputational risk, because a couple of companies tried to do that and they had pretty bad publicity because effectively they get accused of putting people in a modern slavery. When you give the debt and you cannot leave this employee before you repay the debt, they would rather have this relationship with a third party so they're not involved. And I think that's a good hedge from that happening.
That makes a lot of sense. Yeah. So what is your CAC today to get a new $20 a month customer?
That's a good question. I think the average CAC across our product, let's say for the top product, we're talking at about £40 CAC fully loaded versus 200 and plus pounds annual revenue.
So that works. Yeah, that math works. For now, that works. So how big can this be? If everything works out perfectly, how big can this be?
So that's a really good question. So we're talking at the gig economy in UK only of about 20 million. In the US, we're talking 80 million people who have income volatility. But if you add additional services such as credit building, which started offering about a year ago, some overdraft protection, we can easily be helpful or useful in one form or another to about 70 or 80% of workforce, basically excluding top paid office white collar workers who would not require any of those products. So with that in mind, and given that it's fully automated, it could be instantly scalable.
Yep. Well, I'm rooting for you. We'll see what happens. In the meantime, though, Oleg, we're out of time. Let's wrap up with the famous 5. Number 1, favorite book.
Shoe Dog by Phil Knight.
Number Great 2 book. Is there a CEO you're following or studying?
Not really, but I am fascinated by Elon Musk and his combination of building a business, but being very vocal and controversial at the same time.
Number 3, what's your favorite online tool for building steady pay?
Microsoft to-do list. Cannot live without it.
Number 4, how many hours of sleep do you get every night?
I try to do at least 6.
Okay. And what's your situation? Married, single, kids?
Not married, in a relationship, no kids.
Okay. And how old are you?
I'm 36.
Last question. Something you wish you knew when you were 20.
Oh, God. Probably that the consequences are not as big and severe as you expect them to be. So just plan less and do more.
Guys, there you have it. SteadyPay.co celebrating here on the podcast their 10,000th customer and breaking $1 million run rate, up from a $380,000 run rate just a year ago. Healthy growth. They also disclosed a seed round called $5 million, sold between 10 and 20% of their business. Again, they're helping gig economy workers flatten out less volatility with their income streams by advancing them capital on down months and taking it back on up months. They make a little bit of spread on their warehouse facility, $1 million facility, 20% interest rate earned last 12 months on, call it 13, 14% cost. That'll obviously grow margin over time when that flywheel grows. They're negotiating right now for the next warehouse facility. We will see what happens with that. In the meantime, though, Oleg, thanks for taking us to the top.
Yeah, my pleasure, Nathan. Thank you for having me.
One more thing before you go. We have a brand new show every Thursday at 1 p.m. Central. It's called Shark Tank for SaaS. We call it Deal or Bust. One founder comes on, 3 hungry buyers. They try and do a deal live, and the founder shares back-end dashboards, their expenses, their revenue, ARPU, CAC, LTV, you name it, they share it. And the buyers try and make a deal live. It is fun to watch every Thursday, 1 p.m. Central. Additionally, remember, these recorded founder interviews go live. We release them here on YouTube every day at 2 p.m. Central. To make sure you don't miss any of that, make sure you click the subscribe button below here on YouTube, the big red button, and then click the little bell notification to make sure you get notifications when we do go live. I wouldn't want you to miss breaking news in the SaaS world, whether it's an acquisition, a big fundraise, a big sale, a big profitability statement, or something else. I don't want you to miss it. Additionally, if you want to take this conversation deeper and further, we have by far the largest private Slack community for B2B SaaS founders. You want to get in there. We've probably talked about your tool if you're running a company or your firm if you're investing. You can go in there and quickly search and see what people are saying. Sign up for that at nathanlatka.com/Slack. In the meantime, I'm hanging out with you here on YouTube. I'll be in the comments for the next 30 minutes. Feel free to let me know what you thought about this episode. And if you enjoyed it, click the thumbs up. We get a lot of haters that are mad at how aggressive I am on these shows, but I do it so that we can all learn. We have to counter those people. We got to push them away. Click the thumbs up below to counter them and know that I appreciate your guys' support. All right, I'll be in the comments. See ya.